Morning. This is Kay Flannery from Accounting Business Solutions by JCS. We are here to talk today about best practices for closing your books at year-end, things you want to do, and reports you want to prepare. That's supposed to have my email address right there, but oh well. Today, I'm going to focus on 5 areas of the balance sheet and 1 area of the income statement for things you want to be checking every month and particularly at year end. We do have available, if you contact us, this best practices year-end checklist that you can just go right down the list and mark off when you've completed these things. So today I'm going to focus on bank reconciliation, accounts receivable aging, inventory valuation, equipment, furniture, and fixtures additions or disposals, and accounts payable. So when you're ready to start doing your year-end work, you want to print some reports. Report number 1 is the balance sheet. The balance sheet shows what you own, your assets, what you owe, that's liabilities and loans and trade accounts payable, what you owe your vendors, and then owner's equity, what's left. The next report you want to print is the income statement. Generally, it's recommended to look at the income statement compared to 2 years. Show you where it's increased or decreased, and you can research why is this happening. The next report is a general ledger trial balance. The trial balance shows you all the accounts that have a balance in them and whether they're a debit or credit. This is kind of an accounting thing, so if it doesn't make any sense, it never made any sense to me for a long time either. But the trial balance, the most important thing on this is at the bottom, the total of the debits and credits need to be equal. You would say, oh, but the program does that. Why do I need to worry about it? I have seen cases where it has gotten off. It's a techie thing, but you need to be paying attention to it because your CPA will ask you about it. Looking at our balance sheet, I've highlighted the 5 areas that I'm going to focus on today. Bank reconciliations. A bank reconciliation is simply a schedule that shows what does the bank say I have, plus deposits I've recorded in my books that the bank doesn't know about yet. Maybe I recorded them on December 31st and the bank got it on January 2nd. It's going to also show you a list of outstanding checks. Those are checks that you've written and recorded in your books, and the bank, they have not been presented to the bank yet for clearing. So it's a schedule that just makes the sum of the parts. What's the balance per the bank, plus deposits in transit, less outstanding checks, to equal the deposit per the books. The next area is accounts receivable. What does this number consist of? Who owes me that money? So you want to print and you can do these electronically on PDF or whatever. You want to print a report called an aged receivable. It shows you by customer, by invoice number and amount, who owes you what. On this report, you're looking for, why do I have some of these older things outstanding and how am I going to collect them? From the year-end close perspective, you're looking at, does this total on this report that shows me kind of a summary of who owes me what, does this total, $183,000, agree with my balance sheet? In this case, It does. That's good. So we can move on. Looking at inventory. At year end, you want to do a physical count of what you have on hand in your warehouse. After you've made that count, you will be putting those adjustments. The books say I have 5, but when I counted there are only 3. I need to do an adjustment of a -2. You want to put all those adjustments in so that the physical count you took in your books now agree. So for the year end, we want to look at, on the total on this report, $25,000, does that agree with my balance sheet? I've got a problem here. The data that I chose, they've got a problem that those two things don't agree. You need to track that down. Either you're familiar with your software and you know how to track it down, or you need someone like us to help you. But that's a problem. That's why we're checking this stuff instead of ignoring it. And then the CPA comes back and says, well, you know, your report says you should have 25,000 and your books only say this. Where's the difference? The next thing you want to be checking and making a schedule or a little spreadsheet or worksheet is fixed assets, property and equipment. What did you add during the year and what did you dispose of? Maybe you sold it, maybe you scrapped it, maybe you bought a new vehicle, traded your old one. Your CPA tax preparer wants to see a list with supporting documentation of those assets that you purchased. Those assets need to be depreciated over their useful life. That means that you cannot just expense all of that $40,000 in the vehicle in 1 year. You have to use the IRS depreciation review rules. So you want to just make a schedule of those. The next on my top 5 is accounts payable. And again, we're going to do an accounts payable aging report. This aging shows by vendor, by invoice, and invoice number, who do you owe? So if there's some old things on here, now's the time to clean them up. Either you've received a credit from the vendor and you don't owe it, so you want to record that, or you need to return some things to the vendor because they were received damaged. But you're looking here at this report to see if the total on the report, the details of the report, agree with the total on your balance sheet. So my number is $98,010. Looking back to my balance sheet, $97,810. So this data has a problem. We need to track it down. We need to see where in our system we're coding something incorrectly that's causing the GL balance to be different than the detail aging. As we proceed, those are my top 5. If you don't do anything else, do those. The thing on the income statement that you want to tie in is, do the wages that you show in wages expense agree with the 4 quarterly 941 forms? That the gross wages in your payroll register tie, that everything's recorded correctly. You also want to verify what the balances are that you owe. Do you owe on your 401k? Do you owe federal payroll taxes? Do you owe FUTA, that's the federal unemployment, or state withholding or state unemployment, the SUTA? What are the balances that are due as of December 31st that you have not paid? Those totals on those payroll reports will also agree to your W-2s. On your income statement, you're looking at, from a management perspective, how did you do? How much revenue did you bring in? How does it compare to the prior year? And do we have a sense of why there was an increase or decrease? Maybe we started a new product line. It's going gangbusters. Maybe we decided to start recording things differently. So we've got some things in one year, in the prior year categorized one way and another year. We need to understand why those variances or those increases or decreases are occurring. From our gross profit and profitability point of view, cost of goods sold is the direct costs that go into the product we're selling. Many industries have guidelines on expected range of gross profit margin. Should it be 35%? Should it be 60%? And then on your expenses, you want to be looking at where are they going up? Where are they going down? Why am I spending that much in each of those categories? Okay, moving on to due dates of tax return filings after year end. Number one is W-2s and payroll tax returns. The W-2s need to be distributed to the recipient and submitted to the government, either paper mail or electronic, by January 31st. Both the recipient and the government are due their reports by January 31st. Second is Form 1099 MISC. This is the form you use to report payments you have made to individuals or non-corporate entities for services. You do not issue 1099s for purchase of your merchandise you're buying for resale. Those are tangible. This is for services which are intangible. Just one note, you're also required to submit 1099 for any attorney's fees that you paid, no matter what the amount, no matter what kind of business entity they are, individual, partnership, corporation, LLC. Those 1099s are due to the recipient by January 31st, and then also due to the government by January 31st. In the past, those forms to the government, whether it's the W-2s or the 1099s, were not due to the government until February 28th. Now, with all the capability of electronics and expedient filing, both the recipient and the government are due their reports by January 31st on both W-2s and 1099. The next date to be concerned about is March 15th. Not April 15th yet, but March 15th. Corporation tax returns, that's Form 1120 or 1120S, need to be filed by March 15th. That's quick. That means you want to be doing your books on a monthly basis. So at the end of December, you just have one more month to do. If you're not ready, if the tax preparer cannot get the return properly prepared, you can file an extension. The extension is an extension of time to file the return. It is not an extension of time to pay the tax. So along with your extension submitted to the government by March 15th, you need to potentially include some additional payment of tax based on what you estimate your tax total due for that year will be. Hopefully you have made estimates during the year, and there's a small, or maybe you don't need to send an extension payment with your extension. But you need to remember it's only an extension of time to file the return, not time for paying the tax. There are separate penalties for not filing the returns as for not paying the tax, and they add up quickly. So get that extension in, get the return in. Next due date is the one you're probably more familiar with, is April 15th. This is when individual tax returns, Form 1040, and partnerships or LLCs, typically those are Form 1065, those are due April 15th. Again, if you're not ready, if you don't have the return properly compiled, or your CPA hasn't been able to get it done, you can file an extension and check it that you've paid in enough tax. Again, it's only an extension of time to file the return and not an extension of time to pay the tax. Let's go to this other little checklist that I have that shows all of the things that could go on your, make it to the right report here, excuse me, all of the things that you could check when you're giving your stuff to your CPA. You've got the software and the usernames and passwords if you're giving them access, bank reconciliation, inventory, schedule of prepaid. Maybe these are things you've paid but are not expenses yet. We talked about fixed assets, schedule of deposits. Maybe you put first and last month's rent down. You want to make a schedule, a report, a little worksheet. We talked about accounts payable. Reconcile your credit card. Remember, the little rule to the cash basis taxpayer is if the item is charged on your credit card in December, then you don't have to pay it until January, but you can expense it in December. Verify the balances of payroll taxes. We did that. Verify the notes payable. And do you need to do any amortization? Maybe you need to accrue for payroll. Maybe you need to do a property tax declaration. Different states have different rules. So this is the full checklist. And if you want it, you can email me and request it. Again, this is Kay Flannery at Accounting Business Solutions by JCS. My email is kay.flanery, just one N, at jcscomputer.com, or call us at 800-475-1047. Your success is our goal. We have time for a few questions now, if anyone wants to submit any questions. Okay, so my assistant is giving me a question here that says, how do I calculate the depreciation? Well, the good news is you don't have to. Typically, your CPA tax preparer, part of their tax software, calculates the depreciation. They just want to know what assets you still have that you had last year, what you've added, and what you've disposed of. And you let the CPA run their fancy-dancy depreciation programs and calculate it. Then, after they've got the tax return done, you get the entries and the tax return balance sheet and make those entries in your books. So now your books will agree with your balance sheet in your tax return. If your CPA does not do that and volunteer it, you need to specifically ask them. A lot of CPAs don't think that the client wants it or needs it, and it just means they get more work the next year because they have to adjust the beginning balances before they go forward. Okay, we have another question here about what is Section 179? Has to do with fixed assets and depreciation. This is a special rule in the IRS code that affects how you handle your fixed asset additions. This is a tax-related issue, and it varies. How you use it varies depending on your situation. I am not here to give you tax advice. I am here to help you get your books in order so your CPA can do your books and not be given a shoebox of a mess. So that's a tax question that you need to discuss with your tax preparer or CPA. No other questions? Okay, thank you. Again, Kay Flannery, Accounting Business Solutions by JCS, 800-475-1047. See you next month for Check Tuesday.